Now that we have an understanding of systematic versus unsystematic risk, in other words, the ocean is the system, the economy, and it's going to rise and fall as the economic situation dictates. Individual companies on that ocean are the boats, and when the economy rises, all the boats lift. When the economy falls, all the boats go down a little bit with it. So the difference between a rising economy and a falling economy is going to impact every ship on the ocean. But if we talk about this in terms of how to generate a portfolio for ourselves, we're looking at an ocean of stocks, and there are thousands of stocks that you can choose from. And some are bigger than others, some are better companies than others, some are safer than others, and so on. When we talk about diversification, what we're really talking about is having enough different companies, so if one of these companies were to go down, in other words, the ship sinks, that we're not hurt so bad. So if you think about it as diversification as owning a little bit of, say, 100 boats in an ocean, well, if one of them goes down, what's the worst thing that can happen is you lose all the money that you've put in that boat. And if you have 100 shares or 100 different boats and one of them goes down, you've lost 1% of your money. So if you diversify and don't have one boat but have 100 boats, that's 1% in each of 100 boats or 100 different stocks. The most you can lose if Enron happens or some other collapse of a firm that was completely unexpected for whatever reason, then the most you could lose is 1% of your money. Most people think that's a good idea. Now, as you think about diversification, buying a little bit of each of 100 different companies is going to be difficult for you. So a lot of people use mutual funds or index funds to buy one investment that chooses the diversified portfolio for you. So you can think about it buying one investment but still being diversified because the investment you bought has many companies in it. So you're not putting all your money into one boat, you're putting your money into one investment that owns a little piece of many different boats. So when you think about diversification, think about it in terms of systematic risk and unsystematic risk. And the ocean is going to rise or fall all the boats, and you want to have enough money or a little bit of money into a lot of boats, so if one of them capsizes, you get rid of the unsystematic risk and you just end up with systematic risk. And you can't diversify systematic risk. In other words, if the economy goes down, all the boats in the ocean are going to go down with it. Hopefully they won't sink. What you can do is get rid of the chances of you sinking with one boat by having no more of your money into one boat than is you're comfortable with. Some people think 1%, 100 different stocks would be a good number. I particularly think maybe 3% for 33 different stocks would be okay. A 3% loss in any one company, since it's fairly unlikely, might be acceptable. But you certainly don't want to put, say, 50% of your money into each of two different stocks. That would be very risky. A lot of people who have lost money in the past have put all their money onto one stock. There have been companies that have capsized where employees had all of their money in company stock, and they found that they were millionaires yesterday and today they're broke because they had all their money and basically all their eggs in one basket, and the company went under. So when you're thinking about diversification and what this concept is, you're basically trying to put a little bit of money into a lot of different boats. In case the boat sinks, you only lose the money on that boat and the rest of the boats are still available to you. Now there's one more thing about this. Diversification is a risk reduction strategy. And what do we know about lower risk? We get lower returns. Think about it in terms of 50% of your money in 2 stocks versus 1% of your money in 100 stocks. If these 2 stocks do really well, you do really well. In this case, with 1% of your money in 100 stocks, you need all 100 stocks to do well to do the same as the 2 stocks that did well with 50% in each of them. to put it into a more realistic example, think of Bill Gates, who has all of his money tied up in Microsoft. Microsoft did really well, and he's one of the wealthiest men in the world. If Microsoft didn't do well, he wouldn't be one of the wealthiest men in the world. High risk, high reward. In diversification, you're lowering your risk because you've got multiple companies that you own, which is good, but you're also lowering your rewards because all of these companies have to do well for you to get a high return. So it's lower risk, lower return, and if you want to make high returns and high risk, you have to, or higher returns, you have to take higher risks. So diversification is a sound strategy for your typical investor, your average person, because they can remove unsystematic risk, or at least eliminate it down to a reasonable chance of losing money due to a boat capsizing or a company having problems, and live with systematic risk, which is basically the economy and fortunes of the ocean, the tide rising, fortunes of the overall situation getting better. So for average investors, 33 to or over 30 stocks in a portfolio is a good number to think of. If you can't get 30 stocks in your portfolio because your portfolio isn't that high or you don't have that much money, then you should start thinking about things like index funds and mutual funds, which is one investment you can put your money in that has multiple stocks in it or multiple investments in it, so you've diversified that way. So diversification is a great tool to eliminate unsystematic risk, but remember the systematic risk is still there. If the ocean goes down, all the boats in the ocean go down with it, and you're going to take some risk that your investments could lose value in case of a downturn in the overall economy. And obviously everyone with 401k has felt this. So think about diversification as removing unsystematic risk, and but you're still left with systematic risk. It's a risk reduction strategy. And so if you want high risk, high reward, you don't want to diversify, you want to take the chance that Bill Gates did that you can get very rich, then you don't want to diversify. But if you want growth over time and avoid the potential of a devastating loss of one of your two stocks going down and losing 50% of your money, then diversify to 30 or above stocks, and you should lose no more than, say, 3% or less of your money if something really bad happens and your stock collapses. So diversification is a risk reduction strategy that's usually wise for most investors.